Okay, Jack Khan. Just a very quick video on getting back to basics, just how you meld uh, forecast and strategy. This is what I did back in the 80s using Elliott wave theory and just simple wave counting. And you wanted to determine, this is old school, uh, the trend direction first. So Elliott would tell you if you had 5 waves up, that the larger trend was higher. So here you've got 5 waves up, and you'd want to look for a 32% retracement back to the range of the third and fourth wave to find support and to buy there and to put your stop somewhere below that. You can trade station, you can find your retracement level that easily, highlight it in red. You've got the 5 up, you've got an A, B, C, zigzag correction, and you buy. Your target is to exit after 5 waves up. You can project the target by using a ratio or percentage of the first 5 waves, and here's your target. Okay, so that's basically the strategy. Once you have a forecast, then you can develop your trade plan and execute. Let's take a look at this first wave. Okay, so you go down to your 5-minute bar, and you'll find that within that first wave, you've got a little 5 up. You can look inside the 5-minute bar, and you can see your 5 up. You've got 1, 2, 3, 4, and 5 for your first 1, 2. You're playing that first 5 waves up, and you can use the exact same strategy looking for. You're here now on the 5-wave bar, on the 5-minute bar, looking for this pullback here to enter, finding support at the third and fourth wave of lesser degree where you enter, and your target is at the end of 5 waves, and then you do it again. Again, your forecast is determining the trend, looking for 5 waves up, telling you that the larger trend is higher. Then you're looking for a 3-wave pullback, which retraces 0.382, and you get long to trade the next 5 up. Now you can, sometimes the corrections don't end that nicely, they become complex. You get 3, and then you get a 3 up, and you get a 3 down, you get a 3 up, get a 3 down, and as it goes sideways for a while, it becomes complex. You don't know when it's going to come out of that correction. Okay, so you take a step higher, and you apply our technical event model, which is a volatility modeling program or method, and it tells you here with percent C spiking high and historical volatility spiking low that the market is wound up like a spring and ready to break out. It doesn't tell you which direction, but you already have an idea of what direction is going to be because you've got the 5 up. Okay, so you should have confidence to buy on this dip now that you've got a signal from your technical event model that the market is about to go into a dynamic trend. So that's how you advance technical analysis and how you advance Elliott wave theory into something modern and more efficient. Now we'll take it even further. Without even using Elliott wave theory, we use a more elaborate method using the technical event model for dynamics, and we'll use a set of breakout bands, okay, to give us direction. Now here's the daily bar of the volatility index. The volatility futures traded on the CBOE, and you can see how the bands have collapsed. So we get a break above 41.10 to 42.82. You expect the market to move higher. The reason why is because you've got technical event model on the VX on a same type of setup as I showed you on in the Elliott wave example. You have percent C spiking high, you've got historical volatility spiking low, and that's telling you you're going to get a dynamic trend, a forceful trend out of VX when it breaks out. Now, obviously, we could have a bull market and volatility could go ahead and break to the downside and collapse, okay, as the stock market advances. That's one possibility because volatility modeling is direction neutral. On the other hand, volatility could break out, okay, which would mean the stock market is going down. The overbought, oversold model that we have created is currently on a buy signal for volatility. It's an out of gear buy signal. So we're going to have a bias to the upside. We have other information that we use that's given us a bias that is bearish in the stock market and bullish in volatility. Don't need to go into that. But just to show you how we develop a forecast of direction, and then we apply a strategy to it. So now we're status on an algo which only trades scalps, actually, the VX. Okay, and you can see on the May contract that we're engaged. It's only goes long, and this year we didn't start trading it until February 23rd. Verifiably, we did not engage on the short side until February 23rd. It was a Sunday, and we gave the instructions to go status on. Since then, we've been pretty much status on. You can see we've made over $100,000, which is basically 55 to 60% on our account size. That is a scalping system. So we are currently engaged. If the market breaks to the upside, the system will be trading aggressively long. If the market goes down, because it is a trend following system, if the VX market goes down, the stock market goes up. Okay, this system will not trade It is trend following, and we'll recommend to our clients to go status off on this particular hedge technique. So again, this is just a simple analogy to how you forecast with Elliott Wave, develop a trade plan to execute based off that forecast, a particular strategy, and here we have a forecast based on the technical event model, our overbought, oversold model that's giving a buy signal on the VX, along with other information that we've gathered that's price-based, and we are status on this aggressive hedge technique. You can have a visual forecast to pick your strategy to engage, and that strategy can be an algo, it can be a formula, it can be a robotic system to trade. New school way, you're letting the robot execute the trades for you. That's all from here.